what happened in recent weeks is a function of what's been happening for many years here. So, trading, especially equity trading, in our opinion, has become commoditized. And like any product or service in either financial services or any industry, really outside of financial services, and as a product becomes commoditized, it tends to see pricing pressure as well. And so, as equity trading has really become a commodity, in our opinion, pricing pressure has been accelerating. And so you've seen, every several years there's been pricing cuts, around trading. And most recently, what we've seen is really over the past, few quarters, so last year or so, there's been a whole bunch of new entrants into the market with free trading offerings. And we wrote a report actually about a month ago, so this was prior to some of the cuts, that was titled, "Is Free Trading Moving from an Aberration to the Norm?"
Welcome to the Tearsheet Podcast. I'm Zack Miller. Pricing pressure on commissions isn't new in the brokerage space, but it does feel like it's accelerating. Just over the past few weeks, every major brokerage, Schwab, TD Ameritrade, and E-Trade, eliminated commissions over a span of a couple of days. JMP Securities Managing Director Devin Ryan joins us on the show to talk about all the moves in pricing in the investment industry and, more importantly, where this is all headed. We discuss how investment firms will compete if not on cost, and what the impact will be of many new competitors in the space. Devin Ryan joins me today on the Tearsheet Podcast. Before we jump into the interview, I wanted to invite you to Tearsheet's latest event, the Embedded Conference. A big theme on this program and in our reporting has been how financial services are showing up everywhere, in B2B software platforms, in retail, in transportation and travel. The Embedded Conference brings together financial services, fintech, and vertical industries looking to create new financial products. We've got a great speaker lineup. Register today by going to our website and clicking on the Embedded Conference button at the top right of your screen.
My name is Devin Ryan. I'm a Managing Director and Senior Research Analyst for JMP Securities. I cover financial services and fintech for the firm, which essentially is helping our institutional investor clients find interesting stock ideas and educating them around the industry, and also working with a lot of public and private firms just around insights that we have covering the space for the last 15 years.
Have you seen the acceleration of change? Have you seen change accelerate over the past few years?
It's been an exciting time for the industry. I think you have the public markets that we focus quite a bit on. I've covered the financial services space for over 15 years, and really where we started was in the incumbent banks. And so over the last 15 years, there's been a pretty substantial change in the banking industry just around pricing, the types of products that people are focused on, and really evolution of the business model. And so a big theme that we're talking about today is the large cap kind of public companies are really leveraging technology and trying to move downstream and focus on customers that historically weren't profitable and that they couldn't really leverage with the infrastructure that they had in place. And so that's really led us on this journey from a coverage perspective to parts of the market that are more technology centric. And so a lot of my time is spent on interesting businesses and companies that are in the private markets that are competing with some of the big banks and investment banks and wealth management firms that are called the incumbents out there. So there's been a pretty substantial change around the types of products that firms are focused on. There's been change around pricing. We've seen kind of the pricing wars accelerate in commissions over the past even few weeks here, and so that's something that's not new, but it really accelerated, and something that you're happy to kind of go into more details on. And I think there's also changes around consumer preferences and options, and so that's led to I think an evolution within the industry in terms of where firms are focused, but also an opportunity for consumers to have access to financial product that historically many didn't have access to. So happy to go through any of that, but a lot of change over the last few years.
Awesome. We're going to go through all of it. Let's just start with free trading. So you mentioned that there's been some news over the past few weeks. Can you say what happened? And I guess then I'd like to take a little bit further get your thoughts about where this is all headed.
Sure. So, really what happened in recent weeks is a function of what's been happening for many years here. So, trading, especially equity trading, in our opinion, has become commoditized. And like any product or service in either financial services or any industry, really outside of financial services, and as a product becomes commoditized, it tends to see pricing pressure as well. And so, as equity trading has really become a commodity, in our opinion, pricing pressure has been accelerating. And so you've seen, every several years there's been pricing cuts, around trading. And most recently, what we've seen is really over the past few quarters, so last year or so, there's been a whole bunch of new entrants into the market with free trading offerings. And we wrote a report actually about a month ago, so this was prior to some of the cuts, that was titled, "Is Free Trading Moving from an Aberration to the Norm?" And the whole thought around that was highlighting all of the free trading offerings that have kind of propped up over the last year or so. And the interesting thing about them is that many of them have strong financial backing. They're brands that people know, and I think that's very different than the free trading options that have been out there for call it the last decade or so. I think a lot of people that we talk to, their point would be, well, free trading has been around forever, so why is this time different? And our view is that it's very different because you have a lot of credible firms that are out there today, providing that as a capability. And the reason being is because it is a commodity, and that's not really where the value add is in the customer relationship. And so over the past couple of weeks,
Well, can I ask you something? Do you think, I know we have to be careful about mentioning specific names, but do you think the entrance of Robinhood in that space, private company, has added to that dynamic?
Absolutely. I think you have to look at Robinhood's growth over the past few years and be impressed, right? The millions of customers, I think it's over 6 million today, is impressive by any metric. And I know that all the large incumbent firms, the public firms, are paying attention to that. And so it's not just Robinhood. There's a number of other firms that, both large and small, that have come out with free trading offerings, and they're growing. And so that's in some ways stealing a future customer from some of the incumbents. And I think that they're cognizant of that and don't want to be on the wrong side of this theme, especially, to our point, as it's moving from an aberration to the norm. And so to kind of keep the thought going here, we're evolving from a business model where historically trading was one of the primary monetization mechanisms for the industry, to it being a service or a product, if you will, that is just part of the overall customer relationship. And I think that many of the firms in the industry that are going in the direction that we think is probably where we end up are focusing on areas that are less commoditized, and areas where they can really monetize the customer relationship, either through advice, which in our opinion is much more of a customized, personalized service. And over time, we've seen less fee compression around, and we think that firms that are in some way, either through a digital channel or through human relationship providing advice, will be in a position where they can still have a robust kind of business model and opportunity to monetize a customer relationship. But also firms that are providing differentiated service or platform more broadly. And so it's not just about free. And I think even for firms like Robinhood and some of the others that have been evolving their business model, I think they appreciate that's becoming table stakes in and of itself. And so therefore you need to have other capabilities or other connections to the end customer, some type of experience that is differentiated in order to continue to be able to have a profitable business model. But the interesting point, and I think this is important, even if you look at some of the firms that have just moved to zero on commissions over the past few weeks, so Schwab is an example. We went back and looked, and our model goes back to 2000. And if you go back to 2000, their trading commission was over $30 on average per share, right? Wow. And today it's zero. Well, back in 2000, their operating margins were low, They were growing the firm and expanding the footprint. Trading was, call it 40% of overall revenues. Today, before they made the cut, it was roughly 6% or 7% of overall revenues, and their operating margins of the firm were pushing 50%. So, I think that tells you that the industry understands that trading is not kind of the main monetization mechanism, and has already been evolving the business model to be able to make money and serve the customer in different ways, and ultimately grow the franchise and grow earnings power. And so I think the good firms have been figuring that out, that they have to add a lot more capabilities, because there's a lot of areas within financial services, not just trading, that are becoming increasingly commoditized.
Well, Devin, does it go so far as to say that with the margin compression, cost compression, does brokerage or does trading itself turn into a loss leader? I mean, not only not making money, but they have to offer it just as table stakes.
Right. So in some ways, it's a loss leader. I think nothing's ever completely free, right? The old saying. And so there's other ways, even with trading, that firms are making money. So you have payment for order flow, and that's still relatively profitable. You have margin. Some of the product manufacturers that are on the platform are paying a fee. And then ultimately, within every account, there tends to be some percentage of that account that's in cash, and that can be very profitable to the firms. But the actual trading function itself, it really is the commodity. There's plenty of other areas within financial services that are becoming commoditized or are commoditized. We think that a number of areas within investment management, anything that kind of is hugging an index is effectively a commodity. And so you're seeing a lot of firms give away zero fee index funds or mutual funds, and I think that will continue, and you'll see more pricing pressure there. Parts of the custody relationship are commoditized, and so all these things, in our opinion, are going to be effectively given away for very little or for free, as to your point, kind of loss leaders, in order to be able to do more with that customer. And so therefore you have to have more products or capabilities that you can deliver into that customer, some of which hopefully there's still some margin within, so that you can have a profitable business model. If you're relying purely on trading as a business in today, or even moving forward, that's probably not the business model that is going to have substantial growth or room for a lot of operating margin expansion. We think that you'll have to be able to deliver a lot more for the customer, and I think that a lot of the good business models are moving in that direction. We're seeing some really interesting developments around being able to do a lot more for the end customer, where you're really solving something where you're optimizing the assets and liability side of their balance sheet. So the end customer is effectively getting access to their own family office, all of these capabilities to bring in outside accounts and really drill into every part of the asset side of the balance sheet and the liability side of the balance sheet, and improve the asset yield and improve the liability cost. To me, that's where we're evolving towards, where you can provide a lot of advice around that, especially now that you can see, all of the financial assets of the end customer. You can do quite a bit to help them and provide advice around that.
So the data aggregation piece has I guess influenced new delivery models within the advice side of the business. So, but are we going to encounter the same thing there? So we're companies, we see that it's a race to zero on trading. We're moving to advice. That's something you can monetize right now, something very valuable to customers, but isn't it just a matter of time before, a new entrant slashes the prices there? Or is that something that has some type of inelasticity?
Well, I think that it's about how you deliver the advice. Advice, the reason I think firms can still charge, and the reason why financial advisors continue to have a fee rate that has not come under a lot of pressure, is because it's a very personalized, fragmented relationship. Trading commissions get advertised on a billboard, right, where you can see what everybody's charging, and it tends to be kind of that rack rate that everybody knows. Not many people could tell you what a financial advisor at Morgan Stanley is charging relative to a financial advisor at Merrill Lynch versus a financial advisor at Raymond James. And so there's a lot of nuance in that relationship, and it's also a personal relationship, and advice tends to be much more personalized and customized. And so absolutely there'll be delivery mechanisms that have, essentially maybe a low price point, or the customer maybe pays nothing, but there'll be ways within that relationship for the advice provider to generate revenues, in our opinion. So we think that we are kind of going to this model where the aggregation is a tool that allows the aggregator to see the financial picture of that individual, which is very powerful for that firm, but also very powerful for the end customer, because I think that's where you can really start to do work around optimizing the asset yields and the liability costs, if you will, for that individual. So you're essentially providing a personalized family office, and some people are going to maybe have a quarterback or a human attached to that that's a financial advisor that can help do that in an efficient way and be a point of contact. And in some ways, especially as technology evolves, I think there'll be opportunities for it to be a complete digital relationship, and it's providing advice and providing a platform for people that historically had no access to this type of advice or to this type of, call it, balance sheet optimization. And so, that's where, it's one model, but we think that in doing that, firms that can deliver either their own product or have relationships with product manufacturers across the asset and liability side, they're going to be able to be in a position where they can provide a lot of value for the end customer.
So in the few minutes we have, at the end of this conversation, I don't want to let you go without asking you about your view on kind of the rise of what we call challenger banks, these new digital only, banking brands. They all seem to be interested in, they started maybe with a monoline product like a checking account, but they all seem to be rebundling banks and adding in getting closer to mimicking a real bank. You talked about moving upstream for some of these guys, and they all seem bent on issuing some type of product in trading / advice, investment advice. How do you see that playing out? Is this just kind of like, just them, adding on a new product? Are they going to be real competitors in this space? Like, how do you feel? How do you see this whole kind of market playing out?
Yeah, it's a great question. I mean, this is a big theme that we've been focused on, and it's kind of the convergence of business models, and maybe where we started the conversation, where the big banks are becoming more like brokers and offering the full suite of service that many of the wealth management and brokerage firms are offering, and vice versa. The firms that started as brokerages are effectively becoming banks, or many of the startups or challenger banks, as you call them, are evolving their business to provide a lot more capabilities to the customer. I think that's the convergence of the business model, but it also goes to, you can't be in just one individual product. You potentially can be for a while if it's incredibly differentiated and there's a value proposition for the end customer. But I think connecting all of these products into one centralized area is very powerful. And so for the end customer,
and the data that they'll have on the customer, to me, it's mind blowing.
Absolutely, yeah. Absolutely. So that's where you can really dig into being able to underwrite a customer, and not to go on a sidebar here, but the aggregation tools, in our opinion, that provide this kind of holistic view of the customer will provide an opportunity to provide that customer much better access to financial product, because they can be underwritten at a level that firms can feel comfortable if they're offering, say, credit, for an example. If you can see that individual's income and their spending and all their assets and all their liabilities, you can then potentially underwrite them at a better rate than they may get elsewhere, where that information is not packaged as well. And so I think that's going to be very powerful for the customers, for the firms providing it, but I think also very beneficial to the customer. But back to your point around the challenger banks, I do think that it's an area where, and we're seeing it today, many of the firms, even the brokerage firms, that are adding these high yield capabilities
Savings, yeah.
on the bank side, savings, checking, that is going to eat into over time, the market share of banks. And I think banks realize it. The challenge is they have a existing business model. They have an existing operating margin to protect, and so they're only capable of going so far in terms of really raising, call it, deposit rates for customers. But many of these challenger banks are seeing a lot of traction with their higher yielding capabilities because they don't have the physical infrastructure to deliver, and so therefore they can deliver. In some cases they subsidize, but in other cases they can deliver at a higher rate to the end customer because they don't have that infrastructure. So that's a huge advantage. And so we do think that there is room for that to continue to evolve. I think that the firms that are testing with banking capabilities are seeing very good traction, and I think that will continue. So the more types of capabilities on the banking side that firms can deliver to the customer, I think the better. And that just goes back to this whole theme of having either your own product on the asset side of the equation and the liability side of the equation, or being able to partner with firms that have access to that, so that you're providing more of a holistic solution for the end customer that's helping them optimize their personal balance sheet. Call it optimizing their personal net interest margin. And I think that firms are starting to do that, and these capabilities exist today, but I think that that's incredibly powerful, and it goes well beyond the historical relationship between a firm and the customer, where you're helping them, 20 years ago buy a stock, and that was value added because that was the relationship, and then it evolved to financial planning, and let's try to optimize the investment account relative to some benchmark. And today it's all about customized goals-based solutions that I think really help that individual optimize their entire balance sheet, assets, liabilities. And I think we even go beyond that, and we can start to talk about overall life advice and what other capabilities can these firms provide that are beneficial to the individual that may go beyond just their financial needs. And I think that's potentially, bigger picture where we're evolving to, where you're going to be providing more of a life advice relationship than purely opinions around certain investments or some type of call it investment account.
I can't help but finish this conversation and feel like, wow, customers are really well positioned. Costs are going down. The quality of the device is going up. There are more competitors in the space. Like, customers come out of this, I think, like golden, but it still feels like so competitive and just a race to the bottom for anybody competing in the space. It feels like it's getting hyper competitive. I mean, I don't know.
It is.
Thinking about it incorrectly, or? Yeah.
It is, and I think if you go back, though, to the point around Schwab that we made, if you look at their old business model and where they made the majority of their money, they were at a much lower level of profitability than they are today, where that, call it, primary monetization mechanism, has almost gone away, and yet they're more profitable than they've ever been. And so the good firms find ways to add value to the customer, and again, focus on non-commoditized parts of the relationship, because that's where I think the value is, and that's where they can continue to charge. So there are a lot of firms that I think are identifying some of the things that we're talking about in terms of where the puck is going, and so it will remain quite competitive. There will be some startups that I think have success, and the ones that can scale fast enough where they've been able to achieve kind of a level of scale of customer relationships where you can figure out ways to do more with them. Or many of the large incumbents, are still, I think, in a very strong position because they've got good platforms. Now the customer is getting even more value for a lower price point, and they have the customer relationships today where they can continue to find ways to do more with them. And so I look at it a little bit like a barbell, where you do have still some very strong incumbents that are in a good position to succeed, and you have some startups, which is in a very competitive space, that will be in a position to succeed. But clearly, everybody can't win. So the firms that do, in my opinion, are going to be the ones that can find less commoditized ways to deliver value to the end customer. And we're seeing a lot of interesting models develop around kind of where we think the puck is going. So we're pretty excited about it, and we spend a lot of time with many of these private companies.
Devin, it's been a very interesting conversation for me. Thanks for joining us on the Tearsheet Podcast today.
Thanks so much, Zack. Great speaking.